Today we'll talk about creating your own bank to invest in real estate with a whole life insurance policy. With the individuals I've worked with over the years, some that have a net worth of $1 million and some that have a net worth of $100 million, I've always seen a ton of interest in learning how whole life insurance works, particularly if I want to get it right and use it to invest in real estate and create generational wealth. So we'll cover that in detail, but first, I want to ask a few questions. Has anyone ever tried to sell you whole life insurance before? Have you ever heard that a whole life insurance policy is a bad place for your money or that it's a scam? Have you ever heard that it's a great place for your money or that banks, corporations, and wealthy families have it? How about this? Have you ever heard of using a whole life insurance policy as your own bank to invest in real estate? What does that even mean? Well, using a life insurance policy as your own bank means that you are going to get loans from your whole life insurance policy instead of getting loans from a bank. Now, if that sounds confusing, think of it this way. It'd be like buying a property with cash. If you have enough cash on hand, you don't need to get a loan from a bank. The thing is, you'll find that there is a big advantage to taking loans against a life insurance policy instead of using cash to invest in real estate in this case. Question: why would you use a life insurance policy as your own bank? Why would anyone do that? Let's answer that question with this question. Do you ever get frustrated with banks? Let me know if you've ever experienced anything like the following. You see an investment property and say, I want it. So you apply for a loan with a bank. The bank, however, undervalues your property. The payments are inconvenient. The interest rate is way too high. You have to show them your life history multiple times, and it takes forever to get approved. And then you feel like this. Using a whole life insurance policy to buy real estate often reduces a lot of that stress. So how does it work? At a high level, here's how it works. I start by getting a whole life insurance policy. My focus, however, is not on life insurance. Instead, it is on the cash value. The cash value might grow by about 5% per year. And then I take a loan against my policy to go out and buy real estate. Here's the key on this. I still get 5% on my entire cash value, which includes the money that I borrowed. And then that money that I borrowed, I go out and buy a property with that, and I also earn a return on that property. Using a whole life insurance policy is often a faster and easier method than working with an actual bank. Let's compare getting a loan with a bank versus getting a loan from a life insurance policy. We'll start with a bank. So with a bank, what do you have? First, you've got an approval process. You might be denied. The loan amount is determined by the bank. I have to have credit. When I take a loan, it affects my credit. They set the interest rate. There's possible closing costs and fees. I've got to pay everything back on the bank's terms, and it takes forever to get approved, and they control everything. I might feel like this guy again. Versus a life insurance policy loan. There's no approval process. I receive my money within 2 to 3 business days by direct deposit. I cannot be denied, and the maximum loan that I can take is based on whatever I have in cash value. I'll find that there's no credit check and no impact on my credit score. There's both fixed and variable loan rates available. And there's no fees, closing costs, or payment plan requirements. Why people do this, specifically use a whole life insurance policy to invest in real estate, is because they get their money fast, it's convenient, and they are in control. meaning they call the shots as to how and when they repay that policy loan, not a bank or an insurance company stating you must pay it back on our terms. So what people we work with typically do is first, they stop working with a bank. Sometimes this is a gradual process, especially if they are slowly building up the cash value of their life insurance policy. Once they stop working with a bank, though, they then use their own bank for financing. And their own bank is their life insurance policy that was set up for cash value. So we'll go into more detail of this today, but what we'll cover specifically is first, I'll share some stories of clients that I've worked with for years who've used their life insurance policies for real estate. Then we'll talk about the 3 core benefits of the cash value with a whole life insurance policy. This will explain exactly why both individuals and institutions put tons of money here. Then we'll go over getting life insurance right. This is probably the most important piece of the entire presentation because it's where people go wrong and have buyer's remorse with a product. And then we'll go over a case study that analyzes the numbers and will show you exactly how you can use a whole life insurance policy to invest in real estate and how it can improve your overall returns. So my goal today is to help you understand how cash value life insurance can help you grow your money safely, grow your money tax-free, and also get better overall returns on your real estate investments. Sound good? All right. Before we jump into all of that though, a little bit about me. Hello, my name's Steve. Nice to meet you. In my free time, I like to teach about 40,000 people all about whole life insurance. I am the founder and CEO of IBC Global. We currently serve about 3,000 clients, many of which who have 7-figure, 8-figure, and even 9-figure net worths. And one of our largest clients is a bank that is valued at about $1 billion in assets. Our firm, for a very long time, has served real estate investors, particularly those that want to understand how the product works and how the strategy works, and they're very numbers driven. They want to make sure that this is better than what they are already doing right now. And our mission as a company is to make the best life insurance products and solutions available to everyone, both individuals and institutions. I promise all of that is true. And if you'd like to have a conversation about life insurance, I promise it'll be an interesting one. Now, before I started the company, I worked at what was called an executive benefits planning firm. And my job here was to design policies for maximum cash value, specifically for corporations that were purchasing these policies, and they viewed the cash value as an asset on the balance sheet. And when I designed these policies, my job was to make sure that the IRS didn't tax it and give them as much value as possible. But it was here where I learned specific details, first on how to get as much cash value as possible in a life insurance policy. Second, I learned why corporations and banks put millions, in many cases billions of dollars into these products and how anyone can copy them. And then also what life insurance companies to choose. After learning a lot about whole life insurance, I decided to break off on my own and start IBC Global. This is where it all started. So you can see my ride to work. In the beginning, I wanted to put on this professional look, so I spent my money on a really nice suit and tie, but I didn't have anything left over for a car, so I figured I'd drive a 4-wheeler into work. I'm kidding. That was not my ride to work, but that was my office. However, if you stop by today, you wouldn't recognize it. We've renovated it multiple times. That specific building primarily serves as a recording studio today, and our team has also grown as we are at about 30 employees strong. All right, enough about me. Let's talk about some of our clients, specifically those who have used their life insurance policies to buy real estate. We'll start with Mazen and Rasse, who I really like a lot. They're two doctors, they're a married couple who own a successful practice in Naples, Florida. Now, when I connected with them, they wanted to transition out of running their medical practice and into full-time real estate. The main reason why is because the husband in particular, Mazen, had a very demanding schedule and it took up a lot of his time. So they had a goal by about the age of 50 to transition into real estate full-time. So to attain that goal or help attain that goal, they each opened a policy where they put away $100,000 per year. While the policies are primarily purposed for real estate, they've been using them for their business. So they don't have restrictions as to what they have to use their policies for. So they've been using it for their business, which has been pretty cool to see. Next, we've got Tom. Tom owns a $60 million real estate portfolio. Now, he has multiple policies and he uses the cash value as a business line of credit for property improvements and also new purchases. Earlier this year, just a few months ago, he borrowed more than $1 million from one of his policies for a multifamily deal. He was earning 5% on his cash value before he borrowed that $1 million. 5% consistently. After he borrowed that $1 million, he still earned 5% on it. While at the same time, he used it for a multifamily deal, which is also producing him a return. He also gets to pay that loan back however he wants, instead of a bank telling him he must pay it back on a certain schedule. Then we've got Max, my good friend Max. Max invests in commercial real estate. His story was a couple of years ago for one of his commercial properties, the bank said to him, hey, we're going to cut your line of credit in half because the market has changed. It's like, what? I'm perfect with my payments. I've got healthy equity here. What are you talking about? The market has changed. Cut in half. So he does it himself now. So he's built up some very large policies over the years. Anytime he needs a loan, he typically gets it in 2 to 3 business days, and he doesn't have to deal with banks anymore. Now, to use life insurance policies for commercial real estate deals, he's funding them aggressively, his policies that is, at about $600,000 per year. But his minimum commitment is about $60,000. We'll go over how that works a little bit later. Let's talk about the core benefits of the cash value of a whole life insurance policy. Safety, liquidity, and the tax-free benefit. Before I jump into that though, let's begin with the basics. If you're new to whole life insurance, we're going to go through these 3 different colors. We'll start with blue, the death benefit. With a whole life insurance policy, you will always have a death benefit. This is the actual insurance on your life that is paid out if you die. If you have a policy on your spouse or someone else, the death benefit is paid out when they die, when the insured passes. Now, what you'll notice is that the death benefit will gradually increase over time with a whole life insurance policy. And when we do eventually pass, it is paid 100% income tax-free to whoever our beneficiaries are, whether it's our family, a trust, our business, or a combination of all 3. Then we have our premium and PUA rider. We'll explain these terms later. They both represent money you deposit into a whole life insurance policy. Question, with a whole life insurance product, do you think you have to pay premiums for your whole life? You don't. I'll show you some examples in a little bit. And then we've got the cash value, which you'll notice with that green line, it goes nowhere but up. And people who have owned whole life insurance through 2008, their value went nowhere but up. Early 2020, when the market crashed, when COVID first hit, their value went nowhere but up. Regardless of what is going on in the stock market or economy, I'll see my value go nowhere but up, if I set it up correctly. So here's what is attractive about the cash value of a whole life insurance policy. First, it's a safe place you can put money. So what does this mean? First, your money is not invested in the stock market. You'll see guaranteed cash value interest rates, often between 2 and 4.5%. However, when I look at the net growth rate of a life insurance policy, it usually falls somewhere between 4 and 5% annually. Sometimes it's a little bit stronger. You're going to see a real policy that's producing a higher return than that. But to set expectations conservatively, I would say somewhere between 4 to 5%. It's liquid. You can access your money anytime. It can be as early as 10 business days after starting the policy. And here's why a lot of real estate investors and business owners are attracted to it. Your money keeps on compounding when you access it. And then the third reason why so many people are interested in this product is tax-free, if we follow IRS rules, which is very easy to do, and that's primarily on your agent. So, who puts money here? A lot of people do. So do a lot of banks. So here's some banks that everyone has heard of. The largest we see is Bank of America. I've got to update this chart actually. They currently have more than $24.3 billion in the cash value holdings of their life insurance policies. What you'll find is that most banks put as much money as they are legally allowed to put into these products. The main reason why is for the cash value, although the death benefit does have some very significant value from a long-term perspective. The death benefit, if you look at Bank of America, their cash value is at $24 billion. The death benefit is going to be about 3 times that dollar amount. I'll explain how that works when I go over the bank that we work with. I'm going to show you their numbers. Corporations also put money here and have put money here for a long time. The 3 corporations I have up on the screen, I have them here for 2 reasons. The first reason, everybody knows who they are. The second reason, if you were to go back to the founders when they started these companies, you would learn that all 3 of the founders owned whole life insurance, and they borrowed against the cash value of their policies to keep the businesses afloat. Wealthy families put a ton of money here. Now, the definition of a wealthy family is going to vary depending on who you speak with. For one family, it could be $1 million. For another, it could be $100 million when they consider themselves to be wealthy. What many wealthy families do is typically own policies on all of the family members. The cash value is typically accessed, the policies are owned by a trust in many cases. The cash value is accessed as their own family bank, if you want to call it that. So the family can use it whenever they want, however they want, but you typically have a board of family members, sometimes outside advisors that are approving the use of the cash value for business opportunities and family investments. But then you also have the death benefit on each family member. And when each family member passes, the death benefit is paid out 100% income tax-free. And what we see with a lot of the families we work with is that trust that owns the policy is also the beneficiary. So it receives that money income tax-free. And then the trust specifies how those tax-free proceeds should be used for the family. There's a lot more to that, but that's a high-level overview. So while those examples might sound cool, let's go through some of our actual clients. Earlier, I mentioned that one of our biggest clients is a bank. Here's the bank that we work with. So I started working with them in 2020, and they started with a $10 million deposit. In 2021, they made another $10 million deposit. And earlier this year, 2025, I met with the CEO and the chairman of the board, and the chairman asked, what are the rates on these products right now? I said, a little bit higher than 4.6%. He said, all right, that's a no-brainer. And they deposited another $5 million. So they deposited a total of $25 million thus far. Their cash value is greater than $29 million, and their death benefit proceeds are getting close to $66 million. Now, sometimes I get the question, how does that work? Life insurance on a bank, or say it's on a company, like who does it go on? The brick walls of the bank? I used to think that when I was brand new in the industry. It doesn't. So this particular bank has life insurance policies on about 30 of their employees. These are the top 30 employees at the company. The bank's not restricted to only putting it on the top employees, but that is most common. And how it works is when each employee passes, however much life insurance that employee has on their life is paid out income tax-free to guess who? The bank. That's not why the bank does it though. So earlier, when I mentioned that I met with the chairman of the board and the CEO, and he said, hey, it's a no-brainer to deposit another $5 million. Why he said that is because the cash value grows safely and it has a nice tax benefit. That's why. Next, we've got a hedge fund officer. So I'm not going to mention his name because some people might know who he is. He's been interviewed on some money channels over the years. One of the sharpest guys I have ever met. His processing speed is so quick when it comes to numbers and just the stock market and economy. He's worked for JP Morgan. They actually shipped him overseas to Hong Kong for 6 years to head one of their divisions. And he's also worked for Goldman Sachs and knows many of the executives there as well. His story, when we met, was that he had about $5 million sitting in a money market. Why he had that much cash there was to keep it liquid for opportunities. Now, his money market was earning between 4 to 5%, but it was taxable. He's also in the highest tax bracket, and he also lives in New York. He was interested in whole life insurance for the cash value because of the safety, similar to what he has with the money market. It's a safe place you could put money, but what he didn't get with the money market was the tax-free benefit, where he could access that cash value tax-free. So his specific plan is exactly what you see up on the screen, to fund a total of about $2 million over a 4-year period. He might continue to add money after the 4th year, but this is his current plan. The break-even point, which represents when his cash value exceeds his total payments, is the 4th year. And then we've got the annual yield, not the dividend rate, by the way. Anytime you see a dividend rate with a life insurance company, it's never what your money's growing by. It's a gross rate. The annual yield represents the net growth rate. If we calculate what is the cash value growing year over year, peaks out at about 5.45%. Early years, it's negative in the first year. Keep that in mind. But the annual yield is really what he was attracted to. He's a numbers guy. Here's what we looked at. The taxable equivalent yield. Here's what this column means. He would need to earn about 9% in a money market or a taxable account where I've got to pay taxes on the gains as income each year. And then after paying taxes in his 40% tax bracket, he'd be left over with about 5.4%. I'll just put it in a life insurance policy, he says, because I get that 5.4%, but I've got the tax benefit, and there's also no risk. He said this: when I compare cash value life insurance with other fixed assets at some of the top hedge funds in the world, he mentioned Citadel specifically, which is one of the larger hedge funds that specializes in fixed assets. He said the net results are about the same to me as a consumer. The difference, however, is I don't have high management fees that I'm going to have with a hedge fund, and there's no minimum $5 million buy-in. And then he said, it's a crime that more people don't understand this. Do you think he'd put money here if it was a bad idea? No way. Next, my friend Greg. So Greg's a real estate investor. He started his policy right around the time I got married. And these are his actual numbers, by the way. So you'll notice that this chart shows 2015 through 2025. So Greg was interested in a policy because he saw that the cash value grew safely. He really liked the tax benefit, but what he was mainly interested in was using this policy for real estate. And I've got to see him do this over the years. I remember 2 or 3 years in, he was using the cash value for a project he was working on with his son. It was a townhome, so it was pretty neat to see. Now, at this stage in his life, he's no longer making payments. Past 2 years, he's paid zero, and he does not plan on paying anything additional either. What I want to focus on, though, is 2020 through 2022. This was during the height of COVID, and interest rates were as low as I've ever seen them. They were bottomed out. His money's not tied to the market at all. He's earning just under 5% per year without any risk. This year, for 2025, he'll earn about 5.5% with no risk. And we have the tax benefit, which is so sweet. That comes out to about $56,000 in growth this year. Again, tax-free, provided we continue to follow IRS rules, which again is simple. People we work with typically own whole life insurance because it's a safe place for their money. They can access it anytime, and it's got a nice tax benefit. That's what most people express. If you ask them, why do you do this? It's safe, I can use my money anytime, and I like the tax benefit. Now, with all of that said, you can still mess it up. Getting life insurance right. It's important to know what not to do versus what to do. Have you ever been presented a whole life insurance policy and said, this is ugly, like, why would I do this? These numbers just don't make sense to me. This has happened to so many people. The thing is, a life insurance policy can be a very bad place for your money, but it can also be a great place for your money. It's important to know what not to do versus what to do, because people get ripped off with this product all the time. Here's what happens. You get a whole life insurance policy. You're told that it's a great deal and you'll have a ton of cash value long term. Those words are always slipped in there. But then usually after you start the policy, you start to look at your policy and notice that you don't really have any cash value in the beginning. It's zero, or maybe it's 40 or 50% of what you paid, but that means you take a 50 to 60% loss in the first year. You do more research and find out you were sold a bad policy. And then you feel like it's a scam. This is usually what happens to people. Quick story about Doug the doctor. This is a true story, by the way. This happened in my second year in the business. It was 2012 or 2013. Doug read a book about how he could use a whole life insurance policy as his own bank. After reading that book, he wanted a whole life insurance policy, and he said to the 2 agents he met with, I was not one of them, that he wanted to put away $100,000 per year into this life insurance product. So they sold him that. Here's what he got. He paid $100,000 per year. His first year cash value was about $3,500. By the 10th year, he's paid a total of $1 million, and he still doesn't have $1 million. Finally, by year 11, he gets his money back. He stopped payments at this point in time. How much do you think I would make on this? This is a low commission product. If I sold this exact product as is, my commission would be $85,000. And that's my rate being at the highest rate with this particular company. Some companies would pay me up to $134,000. Doug was ripped off. The thing is, he's not alone. A little bit more than 90% of whole life insurance policies that are sold like this. Here's what he didn't know though. He could have had a policy that was set up for high cash value. So what we're going to look at is the same insurance company, the same insurance product, but just setting it up differently. To start, he's going to put away the same $100,000 per year. It's the exact same thing for him. The difference is in the first year, instead of having $3,500 in cash value, he's got about $88,000 in cash value. It's a whole lot more in the first year. Instead of taking 11 years to get his money back, he's cash positive between 3 and 4 years. And for me, the agent, instead of making $85,000 in the first year, I would earn just over $11,000 in the first year with this product. Now, if we look at the bottom, you'll notice that he has about $200,000 more in cash value with this option compared to the first one. And remember, this is the same insurance company, the same insurance product, but just set up differently. So what does that mean? Setting it up differently. Let's go through it in detail. The bad policy. Doug paid $100,000 per year. 100% of his payment went toward what is called the base premium. Do you remember that chart we looked at earlier? The basics, blue, the death benefit, red was the premium and PUA rider. We're going to explain those two terms. First, the base premium. Premium dollars prioritize life insurance first and cash value second. Because all of Doug's payment went towards the insurance premium, he had a very low cash value to start. Compared to the good policy, you'll notice that the base premium is at about 10% of his total payment, and then the other 90% is directed toward that PUA rider. PUA stands for paid up additions. I like to call it a cash dump-in because money I pay here prioritizes cash value first and life insurance second. Because this policy had a very low premium and the bulk of my money going toward the PUA rider, I have a very high cash value to start and more money long term. What's the lesson? I want a good policy with a lot of cash value. Otherwise, I'm going to feel like this. So with all of that said, what I just went through there is not secret knowledge. Why do people get a bad policy? Like, why does this happen? It's usually because they don't know. They don't know where to start, they don't know what questions to ask, and they don't know what to look for. It'd be like me going to a doctor. The doctor diagnoses me with an illness and says, you're going to need multiple surgeries and you'll need these 10 medications for the rest of your life. And they've got side effects that are just going to make me miserable. But then another doctor says, wait a minute, you don't need any of this. In fact, I've had multiple patients with the exact same diagnosis, and I've been able to help them just by making some very big adjustments to their lifestyle. That's it. But I never meet that doctor. I don't know what to look for, and I don't know what questions to ask. Same thing happens with life insurance. What should we look for? 1, look for high cash value in the first year. What does that actually mean? Whatever I pay into the policy, I would look for somewhere between 80 and 90% of your payment to immediately show up in cash value. Next, I would look for a break-even point to fall somewhere between 3 and 5 years. To demonstrate, if we go back to the good policy, the first year, Doug paid $100,000. He has just about $88,000 in cash value. His break-even point is between years 3 and 4. What that means, by the 4th year, he's paid $400,000. By the 4th year, he has $402,000. 2, I would get a flexible policy. So what this means is with a life insurance policy, that red column I saw, with a lot of life insurance companies, you can set it up where you are only committed to that, and then PUAs, which accelerate the cash value growth, can be added to the policy at your leisure. To illustrate flexibility, my friend Lance. So he's a real estate investor. He started his policy back in 2019. He wanted a policy where he could fund up to $120,000 per year. However, he was adamant about not getting a bill for $120,000 every year. He said, Steve, while I think I can do this very easily based on his income and assets, if I get a bill for six figures, it's going to stress me out. He was also in the mortgage industry. He lived through 2008. He just didn't want that. So how we set the policy up is where he's only committed to a minimum of about $13,000. That's what he gets a bill for. But he can still pay up to $120K per year, and he has a lot of cash value as a result. Step 3, choose a major mutual company. One reason why, I've seen proof of performance. Big issue in the life insurance industry is a projection shows certain values and then it under-delivers. People don't like that because it's their money. I've seen proof of strong performance with these companies. There they are. They also pay the lowest commissions in the industry when you look at whole life insurance products, which is good information to be aware of. So what were the 3 things to look for? To recap, make sure the policy is set up for high cash value, get a flexible policy, and choose a major mutual company. Clients of ours who follow these steps have a lot of cash value. All right, we're on the home stretch. Section 3, using a life insurance policy to buy real estate, the numbers. Let's start with this question. How does it work? You take a loan from your policy. Simple as that. Here's the thing though. When you take a loan from your policy, you keep earning dividends on your entire cash value. To illustrate, it'd be like having $1 million in the bank and the bank is giving you 5% per year. But you then take $500,000 out, so you're only left with $500,000, but your bank says to you, you know what? Because we like you so much, we're still going to give you 5% on the full $1 million, even though you pulled $500,000 out. Bank accounts don't work like that, unfortunately. But life insurance does. Your money keeps on compounding when you use it. Now, a question that comes up a lot here is how? How and why sometimes does the insurance company do this? 2 ways. First, they've reduced your death benefit by the amount that you borrow. We'll go through this in the example. And then second, they also charge you interest on the amount that you borrow. So we're going to look at a case study. We'll look at someone funding a policy for 5 years. They're going to purchase a $300,000 investment property, and we'll analyze the net return on the policy and also the real estate investment. First, we'll look at the policy, and then we'll add the real estate to the equation. Let's start with the policy. Here's what it looks like if I just put money in. Here's the best place to start. He's funding $100K per year for 5 years. After the 5th year, he pays in zero forever. If we look at year 6, which is when he is 50 years old, he's got about $535,000 in cash value. Then he lets it sit and grow. And toward the bottom of the chart, when he's 58 years old, he's got $755,000 in cash value. That's what it looks like if I just let it sit and grow. Now let's look at this exact same policy, but taking that $300,000 loan. Here we go. He takes a $300K loan. If I'm you, the question I'm asking is, what does that $300K loan do to my policy? What's the impact it has on it? The cash value. I took the $300K loan at 50 years old. Is now worth $218,000 and change. Before the loan, it was worth a little bit more than $500,000. So I see it reduce by about $300K. My cash value is the equity that I have access to. That determines how much I can borrow. When I borrow against my equity, my line of credit, the cash value, my death benefit is held as collateral. Before the loan, it was 1.8 million. I borrowed 300,000. Now my death benefit is worth $1.5 million if I were to pass. We'll start to repay the loan next. We can pay it back however and whenever we want. Here, we're going to pay it at $50,000 per year, and I can see how much is applied to the principal each year and how much is applied to the interest, and then my loan balance shrinks as I pay it down. Here's the bottom line. What do my numbers look like after I pay the loan off? That's what I'd want to know. Here you go. A lot of numbers. Let's zoom into the bottom. What do you notice? They're the same. $755,000 via cash value and then $1.8 million when I look at the death benefit. In the example where I let it sit and grow, and in the example when I borrowed and repaid. Your cash value kept on compounding even though you used it, which means you can then use that cash value to go out and purchase real estate, while at the same time it keeps compounding between 4 to 5% annually. This is what people do. This is how they leverage a policy to buy real estate. They earn a return on their policy. They then use that money that's in their policy to go out and earn a return on real estate. Sometimes I hear something like, I feel like I'm earning 2 rates of return on $1. And they don't have to deal with a bank. Sound good? What's the catch? There's always a catch, right? Know your numbers. Here's what I like to look at to get to the true numbers. Cash value growth, cost to borrow, return on real estate. Cash value growth minus loan interest plus real estate income. What this shows you is how much the insurance company is paying you in total dividends and interest every year, minus what you're paying to the insurance company in interest every year, plus income you're receiving on your real estate that you purchased with your policy loan. Let's start with the cash value growth. I'll go over how you can look at this. So let's start with the first year. You paid $100K, you got $92,000 in change. That results in a loss in the first year of about $7,700. This is the drawback that everyone always tries to hide or brush over, and it drives me nuts. There are drawbacks to this. The first year is the worst year, and it takes him just about 4 years to get his money back in this example. So I'm running a loss during the early years. Now, while the first year is the worst year, every year after the first year is the best year, or are the best years. So if I look at year 10, his cash value is $636 and change. He pays nothing in year 11, and his cash value grows to $663 and change. That comes out to just about $27,000 in growth that year. So the cash value growth shows you how much money you received from the insurance company in 1 year. Next, the loan interest. This is pretty simple. We usually know what we're paying in loan interest. Here, we take a $300K loan, and if we look at year 7 in this example, this is when we were paying interest on the full $300,000. $16,680 is what we paid in this example. If we would have taken $400,000, we would pay more in loan interest. So it is important to look at how much you're borrowing, as that will impact the loan interest. But the loan interest in the model we're going to look at simply shows you what you paid in interest for 1 year, and then the real estate return. Here we've got a $300K property. We're assuming a 10% return, which comes out to $30,000 annually. That's pretty simple, how much I get in income from my real estate every year. All right, the net numbers. So cash value growth minus loan interest. This is exactly what we do for our clients, by the way, when we're breaking down the net returns. If we look at year 7, my growth that year in the policy, $23,886, which remember, That's consistent regardless if I have a loan outstanding or not. So we have a $300,000 loan outstanding. Again, my earnings, $23,800. Loan interest, $16,680. That's what I paid to the insurance company. So if I take what I earned and subtract what I paid, I have a net of $7,206. If I just stop there, I'm positive in year 7. I could go out and buy a car with it if I want. I'm positive in year 7. If I decrease that loan to $200,000, that spread would look better. If I made it $400,000, the spread would not look as good. But I'm positive. Let's make it better. We've got to add the real estate return here. So what we're going to do is take our whole life insurance policy. We're going to loan $300,000 to purchase the property we want, which is giving us a 10% return, which comes out to $30,000 annually. Then we add that to get our total return. Okay, so the net policy earnings, again, was $7,206 plus the real estate return of $30K in this example. Add the two together, that's my total return, just in bottom line dollars. That was also year 7. That's when the interest was the highest. What about when the loan's paid off in year 15? My growth, $33,000 and change. My real estate income, still $30,000. Total return just for that year, $63,000 and change. What I like to do sometimes is add another column that shows the cumulative return. And if we're taking loans immediately, it'll be negative. So we do like to show that to clients just so they are fully aware of the pros and cons, just as I would want to be fully aware. Here's how it works though. You earn interest on your entire cash value. You pay interest only on the loan balance, while at the same time you earn interest on your real estate. The lesson, your money keeps on compounding. Okay, I know that was a lot. Let's recap the real estate strategy. We've got you. You get a whole life insurance policy. You see that it's earning 5% per year. You then see a property and say, I want that property, mainly because it's giving me 10% per year. To get that property, you take a loan from your life insurance policy and purchase it. That property is then earning 10% per year. You could take some or all of that 10% to repay the policy loan, while at the same time, you're getting 5% in the policy, the property is still producing 10%, all with the same dollar. We're using the money that we originally used to fund the life insurance policy. Constant compounding. Make sense? Fun stuff, isn't it? So, in summary, real estate investors we work with use whole life insurance because it's a safe place for their money, it's easy to access and keeps compounding when they access it. It's also tax-free, provided we follow IRS rules. So, let me ask a few questions. First, do you see why banks, wealthy families, and real estate investors use cash value life insurance? How they could use it as their own bank, or if it's just for the safety, liquidity, and tax benefit that comes with it. Do you see how you can choose the right policy? Specifically, what not to do, like what we saw with our friend Doug, versus what to do. And then do you see how the numbers work? Specifically, if you plan on using the policy for real estate. Do you see how it can enhance your overall returns? So from here, we've got 2 choices. 1, you might need more information. 2, you could be excited to implement. So firstly, if you need more information, we've got plenty of it. You can visit our website, ibcglobalinc.com. You could also visit our YouTube channel where we have well over 1,000 videos. I believe it's getting close to 2,000 videos, but you'll see hundreds of case studies that are specifically designed or made for real estate investors and business owners. On the real estate investor side of things, you'll see case studies for individuals purchasing small homes, multifamily homes, high-end commercial real estate. We've got a ton. We also have a lot of guides available. One is our guide that provides steps on how you could use a policy to purchase real estate. You can find this on our website, or you could reach out to us direct and we can provide this to you. It's very similar to what we saw in this presentation. We also have my book, which will be released within the next 1 to 2 months. We are just about there. If you're interested in a copy, please reach out to me personally, and we can definitely jot you down to get you early access to it. I've been working on this thing forever. I am so excited. We've got a lot of examples on loans and everything you just saw in this presentation and a whole lot more. If you'd like to see some numbers before meeting, I like to always say this because I'm like this myself. We can provide numbers to you. We've got an intake form. It's a one-page form. It's online, but it's just a few questions that we ask to collect really just the bare minimum of information needed in order to prepare custom illustrations for you. So this way you can see what do different policies look like for me. If I'm going to put in $1,000, $10,000, $1 million per year, I want my funding to vary every year. I'm going to put in a different amount. We can show you exactly what it looks like. And then afterwards, if you'd like to meet, we can certainly schedule something, but zero pressure at all. Now, if you're excited to implement, you can let us know through our website. If you visit our site, we can certainly reach out to you, or you can email me or call our office direct and just let us know that you viewed this specific presentation about how to create your own bank to invest in real estate with a whole life insurance policy, and I will definitely make sure I get back to you ASAP, or if someone on my team touches base with you to schedule some time to connect, I'll definitely make sure that I am on that call. So with all of that said, thank you so much for watching. Let's open the floor to questions.